We talk about it just about every year, and that is the old adage that you sell in May, go away. We always comes up a little different this year because it wasn't April 15th. These things are thrown off tax-wise. But according to LPL Financial, the S&P returns 1.7% on average between May and October for those 6 months, and it returns 6.8% on average from November to April. And over the past 6 months, the index is up close to 30%. Joining us now to talk about what to do with this in mind, Ryan Dietrich, Senior Market Strategist at LPL Financial Research, and Stephanie Link, Chief Strategist at Hightower and a CNBC contributor. We mentioned LPL, so I'll start with you, Ryan. You also point out, though, that there, and once again, the caveat is I don't know what historical trends necessarily mean, and a lot of times they're meant to be broken. But whenever the S&P is up 5% in April, it tends to do really well in May, 9 out of 10 times. And that's the case this year because April was a big month.
You're right, Joe. I mean, you think about it, it should be called sell in June, if you ask me, right? I mean, you look back at the last 8 years, May's been higher, 7 of them. During a post-election year like we are, May historically is extremely strong. And then you just mentioned when April's up a lot, May's been higher 9 of the last 10 times. So those are all there. But the truth is, after an 87% rally, the calendar is, you could say, more of a warning sign now. We know summer months can be low volume, more volatility. I mean, just overlay this bull market with the one that we saw coming off the 2009, 2010 lows. You know, that one we had almost identical. That one had a 16% correction in the sell in May period in the summer months. Maybe we don't quite get 16% with all the stimulus that's out there, but still, you know, a well-deserved break makes sense, and the calendar is a near-term worry here.
And Stephanie, that's the thing. I mean, calendars are one thing, but it doesn't matter what month or day it is if you just look around and try to figure out sentiment and you know, just how far we've come and maybe some of the, you know, pockets of speculation that are troublesome. So I don't even know if it matters that you need to know what month or day it is. But do you feel like maybe this year it may be a better idea than in previous years to maybe lighten up a little in May?
Well, good morning. I will tell you, this morning alone, I've read 4 different notes on sell in May. So people, it's on the topic, obviously, and the top of mind on investors. Look, seasonally, it is always a sluggish period. May, June, July, summertime. I feel it in my own portfolio. The first and fourth quarters are always really strong, and then in the middle part of the year, it's always a little bit more challenging. But look, Joe, it's really tough to market time. And at the same time, we have record liquidity. M2 is up 26%. We all know that story. And so I think any kind of pause or dip gets bought, especially when you think about the fundamentals, right? I mean, the economy is absolutely booming, 6.4% GDP growth. We're probably going to double that in the second quarter. Personal consumption at 10.7%. Personal income, I've never seen a number like this before in my life, up 21.2%. So there's so much pent-up demand on the consumer side. Manufacturing is absolutely humming. And then earnings. Oh, by the way, earnings are up 51% year over year. I get it. Very easy comparisons. But earnings are coming through. And so when I think about fundamentals and I think about the seasonality, I think, OK, well, if we do get a pause, let's make a shopping list. And I have a whole bunch of names I would be buying into that weakness.
Yep. Sounds like a buying. The dip will continue. And Ryan, I think Stephanie just made a pretty interesting point that I've seen bandied about, and that is, in our most despondent days at the height of the pandemic and when the market was showing a lot of weakness and we were most concerned, and then it came back with a vengeance, and we kind of said, well, all the reopening good news is now already reflected. How are we possibly going to live up to this? And it has. And that was understated what the actual pent-up demand was going to be. And we're seeing it now. So it hadn't paid everything forward. There was a lot more to go 3, 4, 5 months after the lows that we saw, and here we are. So I don't know. Does it last forever, though, Ryan? And I can't imagine that some of the stuff we're hearing out of Washington doesn't become a headwind at some point. Are you worried about any of these things, or you just don't think they're going to pass?
No, there's always worries, and we don't think it'll last forever. I mean, I agree with everything Stephanie just said. But when you look historically, when you have ISM manufacturing up over 60, the 3 and 6 month returns on the S&P are actually negative, right? The truth is, everyone knows we've opened up. Everyone knows how good things are. The inner contrarian in me wonders, could it finally be time, at least for a consolidation here? Maybe even, after an 87% rally, heaven forbid, a 10% correction, which, like Stephanie said, we'd be actively looking to buy it. We're kind of a 50-50 here, growth value. Last year, we liked growth a lot. We've evened up. We think there's opportunity on both sides, and get those shopping lists ready, because it'll be a buying opportunity in our view at LPL Research.
Shepard Smith here. Thanks for watching CNBC on YouTube.